Hi traders, welcome to Market Outlook. Trends, risk events and trade setups brought to you by Vantage Markets. This is a weekly webinar where we focus on the key events and themes during markets. At the moment, so much going on and just trying to sort of collate everything, all the drivers, all the themes, but obviously we try and look at the kind of medium-term narratives driving the markets. Obviously, we're interested in the short term as well, and that has taken some time actually this morning, obviously with things going on in the UK, especially this morning. But yes, we try and look at the main themes and drivers which are moving markets at the moment. While I just let you have a look at the disclaimer, we try to break down market jargon and complexities. So if you have any questions, please do ask them along the way or at the end, and we'll try and answer those as best we can. Or you can obviously email us and we'll go into more depth potentially around any questions you have at all. However complex or easy, please do ask questions. It's the best way of learning what is going on in the markets and obviously making better trading decisions in the long term. I can't guarantee, of course, that I'll have all the answers, but I'll try and define what we see as the key points and also then break down any of those, as I say, complexities in the markets and what is driving them at the moment. Initially, we'll look at Fed rate expectations actually, because they are moving higher after last week's CPI data, especially. So we think that's the key longer-term driver of markets and has been, of course, for a while. We'll look at the dollar and a couple of the majors, dollar yen, euro dollar briefly, technically, and fundamentally. We'll then also look at stocks. It's a big week for some stock earnings releases, including Netflix and then Tesla on Thursday. Always a favorite with retail investors, of course, one of the most heavily traded stocks. And we'll have a little breakdown of what's expected and for Netflix as well as Tesla. We'll look at the indexes there, the US main indices, so the S&P, the NASDAQ and the Dow, and we'll also then review, as we do, many of you know, we'll review just quickly the US CPI data. It's key data and we always think it's worth just recapping on the events, what happened, and obviously the implications for that. We'll look at gold as well, just technically and what's happening on that chart. Quite a move last week really on the back of US CPI, and then obviously the reverse, if you like, on the Friday in risky assets especially. And then hopefully we'll wrap up with the UK and sterling, cable, and just what's been happening this morning as well, and the sort of likelihood of what's to happen and some of the drivers there going forward. As I mentioned, firstly, we'll look at this week and what's been happening in markets at the moment. Well, we've returned from the weekend really with a greater appetite for risk. We're trying to bounce back from that sell-off on Friday that I've just mentioned, and certainly the gyrations, that volatility we saw late last week. Huge volatility in US stocks, especially on Thursday and then Friday as well. Certainly GBP, sterling, that's been making the headlines, as I've mentioned this morning, and the new Chancellor, the new Finance Minister's speech in the last hour, and a reversal of pretty much all the new government's original tax plans from that so-called mini budget. It is probably very mini now, in fact, from the 23rd of September. Asian stocks and stocks in Europe actually bouncing, as I've said. Asian stocks traded lower following that Wall Street slump on Friday. And really, there's been some focus, of course, on China. They have a fair bit of data out, GDP data, retail sales, investment data out. And we've obviously got the party conference in China. And there was a keynote speech by the president, which really heavily focused on technology to drive growth. This was the key points for markets, really. Technology driving growth and potentially open the door for potentially less restrictive policies in the longer run. But markets in the more immediate term didn't really find any hints from the speech that, crucially, the zero COVID policy will change, or that the Chinese market will become more attractive in the near term. Probably the key takeaways from that speech. As I say, at the moment, it's about Fed rate expectations. Here's a chart you can see. We like looking at this, a CME group interest rate, Fed funds futures on a bar chart. Really great chart, really great website to follow interest rate expectations, which of course have been driving the markets this way and that, really. These are Fed rate expectations, of course, and we're now pushing to a 5% peak for the May 2023 meeting. You can see here, I've clicked on, that's on the 3rd of May, that meeting. We're up to sort of 5%, as I've just said. And you can see, just looking at the below sort of table, where we are now is 4.75% to 5%, chances 42%. And you can see that move just from a month ago, where it was just only 8% chances of getting towards or getting to 5%. So a massive move. I think a full 1% increase in peak rate. This is the peak rate, the terminal rate, some people like to call it. That's just the peak rate in Fed funds, a full 1% increase in just over 1 month. And that's really down to sort of, if we think about fundamental reasons, that's, of course, that strong NFP, the strong US employment data at the start of the month. We then had, obviously, last week's CPI, which we'll dive into shortly. With the core inflation rate hitting a 40-year high, so not going down at all. And then we've had this continued hawkish Fed rhetoric. So even when we had, obviously, that hope for next or another pivot, the Fed pivot, that is, so where markets obviously hoping for a pause or a stop to this peak rate, and then obviously at some point a cutting of these rates, and that obviously hasn't happened. If we listen to the Fed speakers, Fed officials on the wires constantly last week, the week before, continually hawkish. We did, I think a couple of weeks ago, sort of highlighted the fact that, yes, if there were market eruptions, then potentially they may slow down, and that was a sort of first hint. But you can sort of feel, in a way, the desperation of markets, because they are clinging on to that sort of one-liner, whereas the whole, or virtually the majority of the chorus of Fed speakers are hawkish and remain hawkish in their fight against inflation and bring it back down to the 2% target. Let's not forget the Fed target of 2% for inflation, that is, bringing that back down as quickly as they can. This all points then to continued support, we think, for the dollar, and certainly in the absence of alternatives. And that's exactly what we've been saying for some time. You look around the globe, the uncertainties, the recession in Europe, UK, volatility, China, COVID issues still lingering. There is not a lot of alternative to the dollar, and hence why you've seen such sort of support and also an underpinning of support. So when we have sold off briefly, that we did towards the sort of start of this month, of course, that pivot even, then we've obviously had decent data supporting more buying of the dollar. I think it's worth just highlighting, just briefly from last week as well, just another set of officials, if you like. The IMF were in Washington, and they reiterated really what I've just said, really. Just this backing of central bankers in their fight against inflation, warning to politicians against sort of fiscal policy, working at cross purposes to monetary policy, and that was obviously particularly relating to the UK. And then really also in those meetings, we had the opportunity for the G7, the G20, central bank governors, finance ministers to potentially talk about FX. But there weren't. There was speculation that there might be some sort of language around dollar strength, but really there's been no change in that FX language, if you like, in the communique, and it's really consistent with remarks that we've seen, say, from Treasury Secretary Janet Yellen earlier last week, actually, who said the exchange rate should be market determined. And then we also had President Biden stating actually over the weekend that he was not concerned about dollar strength. This all kind of squashes any rumors of some sort of joint and voluntary, say, devaluation in the dollar, this kind of Plaza 2 accord that you might have been hearing about, and potentially some sort of pushback against dollar strength. It plays against that. It quashes any of those ideas, really. And certainly we have to think, and we're looking ahead, say, to the US midterm elections on November the 8th. And sort of, it would be, you have to think, really politically hazardous, really, to sort of call for a drop in the dollar, which would obviously then slow up this fight against inflation. So 5%, as we said, the peak rate now, or near enough 5%, getting to close to 5%, which is underpinning support for the dollar, certainly. There's not a lot of US data. We'll touch on that a bit later after we've done the CPI review. Not too much data. And for currencies then, really we're sort of at a couple of critical levels for some of the currencies. Dollar against the CNH. This is the chart. The Chinese currency, really, that remains pinned near 720. The previous high was around there from 2019, 2020. So sort of critical level here for dollar CNH. And then also we have, of course, dollar yen. Amazing run continues. New highs again, really against broad sort of yen weakness, if you like. There's other pairs, euro yen, for example, that's nearing a multi-year high above 145. And certainly there's all this speculation about intervention from the BOJ, verbal intervention. And also we're hearing from desks generally just this idea around stealth intervention. So that's where the Ministry of Finance in Japan, the authorities, they're intervening more quietly, if you like. So they're not announcing to dealing desks that they're intervening, but they're trying to push back against this this very strong rise in dollar yen, in yen weakness. I think the Bank of Japan daily balances, they actually showed authorities there, they sold just less than 7 billion to defend the yen. That was last week. But if you remember the first intervention from last month, that was near a record 20 billion. So perhaps they're trying to intervene, as I say, stealth intervention, it's kind of known as. But at the moment, you can see, obviously, the results are not really working. We've said this consistently before about unilateral intervention by whoever it is, but generally by Japanese authorities. History has shown that this doesn't really work, and numerous occasions since the 80s, and it's worked, I think, maybe once. And it's key, really, as we say, that it's not unilateral intervention. FX intervention needs to be done by several or numerous countries for it to work generally. I think in our daily commentary, I think I wrote about intervention. It's better to have no intervention than unilateral intervention, or some quote similar to that. But I think you get the picture here, or of our thoughts really about how this is working out, and the chart is really telling us that as well. We're currently, so you can see just on this dollar yen, actually, we're currently above that previous level, previous intervention level, where everybody thought the line in the sand was 145. So the previous intervention sort of 145.90. And of course, now we're above actually the 147.67 level for a long-term long-term spike high back from 02, I think. So we're actually above that now. That was our kind of target if we were breaking out of this sort of intervention area, or previous intervention area, I should say. We're above now 147.67, so that sort of should act as some sort of support. And seemingly we're heading towards, the key psychological 150 level now. Amazing, really, when you think about where we've come from. But yes, that's definitely in the target for many. And as well, if we just step back, certainly a move above 150, that could potentially then trigger an acceleration of the yen sell-off, which is kind of exactly what Japan is trying to avoid. So a lot to watch out for here. But as I say, unilateral intervention will struggle, and any sort of intervention by several countries looks, as we've just explained, very unlikely, and especially before those US midterm elections. Elsewhere, we should just touch on euro dollar. Has been sort of quite quiet. I haven't mentioned euro dollar that much in the last few weeks. Certainly, the pound sterling has been grabbing all the attention, and euro dollar sort of slightly impacted by all the noise, really, but quite quiet, really. Just on the fundamental side for Europe, actually, we get EU members reaching a final decision this week, hopeful, on coordinated measures against the energy crisis. We've had various ECB members on the wires over the last few weeks, and market pricing now is around 70 basis points for a rate hike at the ECB meeting at the end of this month, October the 27th, so next week. And then rates are seen rising to near 3% next year. And that, we should say and add, is well above the neutral or the estimated rate, the estimated neutral rate, that is, which is sort of around 2%. Just on that neutral rate, if you think about it, that is the rate which is kind of consistent with full employment and capacity utilization and stable prices. So it's sort of not too hot, if you like, and not too cold, and sort of speculation around where that is. Some differences between economists, of course, but I think sort of the ECB, the rate there in Europe, estimated neutral rate is around 2%. So markets going way beyond that and thinking the ECB has a lot more heavy lifting to do. But obviously, in simple terms, we think about that 3%, not even 3% in Europe next year, as opposed to sort of potentially this 5% peak around that in the Fed funds rate. Technically, just on euro dollar, we should add then we're still in this long-term bear channel. You can see the sort of grayed out area there, that descending channel, series of lower lows, lower highs, very neat, really. We get to the top of the channel, top of that trend line resistance, if you like, and then we come off that and we move lower. And then similarly, when we get to the bottom of the channel, we seem to bounce, and you can see that there. We obviously had parity, which hasn't really sort of proves that sort of a decent technical level, if you like, but it's really been 98.63 sort of we highlighted there as the sort of key level of support, and then resistance. And then below that, we've got, sorry, that's 99.52 actually, so just below parity. And then this level we like from the 6th of September low around 98.63. So that potentially caps prices as well as the 21-day moving average. That's a 97.84, that light grey line. And then just above there, matching that mid-July low is the 50-day moving average around 99.37. We did say that it's a big week for earnings, big week for stocks. So we think it's definitely worth having a look at what's going on there. Earnings season, third quarter earnings season, this continues this week. really people looking out for signs of strain from high prices and inflation, and then also strains from rising borrowing costs. And last week we had the big US investment banks, sort of four there, two beats, JP Morgan, Citibank, two misses, Morgan Stanley and Wells Fargo. And Morgan Stanley actually dropped around 5%, just under, from a drop-off in investment banking fees. But this week, the focus is on, as I say, Netflix is on, Tesla, probably the biggest one. Before that, we have Lockheed Martin, a big defense giant in the US. That's on Tuesday. So that might be interesting, given obviously the ongoing war in the Ukraine. We've also had Procter & Gamble. So that's one of the largest consumer staples companies in the world. They report on Wednesday. So we'll get an insight there on really consumer goods inflation, if you like, and the price pressures there. But as I say, the main two, Netflix and Tesla. For Netflix, they report on Tuesday. Really, investors will be watching to see if it's able to stem the bleeding, really, after losing subscribers in each of the first two quarters. And Netflix woes, really, they've led the company to do probably what was previously unthinkable, if you've been following the stock. Announced plans just last week for a cheaper subscription plan supported by advertising. And basically, they're going to launch this ad-based version in November. It's a bold decision. Some analysts are saying it's kind of defensive. It's not really offensive, if you like, and it's fraught with risk that potentially continues to be underappreciated. But generally, for this sector, really, recession worries are leading many consumers to cut back, of course, on how much they plan to spend on streaming services. And that's really bad news, of course, for Netflix. And certainly, this is affecting the whole sector, as I've said. It's kind of this spin down, I think they're calling it, some of the analysts, into lower price plans by users if then we get, a worsening growth outlook, worsening recession over the next 6 to 12 months. So that essentially means consumers are ditching those more expensive plans for less profitable, cheaper subscriptions. I've mentioned sort of competition as well. There is massive competition now in this sort of streaming area. Disney, obviously, Amazon Prime, Apple Plus, Paramount Plus, HBO Max, all these companies are vying for a piece of this streaming content, the streaming pie, if you like. But then their shares, similarly, shares of Disney, for example, they're down nearly 40% this year, sorry. And similarly, if we just have a look at Netflix, just briefly, chart is obviously pretty horrible after the last, the first quarter earnings, if you remember, and a massive tank in the stock, and we're sort of back to pretty much that gap sort of level there around 230, 230 close, 235 around there. Charts sort of don't really help that much in this sort of area. Obviously, not looking pretty. And really, the focus will be on these subscription levels, subscription numbers, sorry, and then the potential, any talk about this this ad-based version of Netflix. Can't add too much, as I say, on the chart, but if we look at Tesla, more interesting for sure. So they're releasing their results on Thursday. As I say, probably the most important release for this week due to its market valuation and certainly its affiliation with retail investors. Tesla recently missed on Q3 deliveries as they reported weaker production. And analysts then reduced some of the Q3 estimates. The stock actually was one of the worst performers in mega caps just on Friday. It fell 7.6%. You can see 7.55% to its lowest level now in 16 months. And shares are actually now 50% off its November 4th record high. So as for the results, well, Wall Street still expects actually extremely strong sales and earnings growth, with consensus forecasts calling for more than a 60% jump in revenue and profit. But analysts then, as I say, they've been trimming their estimates in the past few weeks. And this is kind of due to a multitude of factors, really, including growing competitions for sure amid the entire auto sector. That is certainly still struggling and is struggling as we go into this potential global recession, as well as then surging energy costs. Of course, with Tesla, we can't ignore the Elon Musk situation, and then with that, of course, the upside, but also then other issues like the Twitter saga for Tesla investors. That's a kind of distraction for sure. And two of the biggest issues are probably the overhang from an eventual Tesla stock sale by Elon Musk to finance the deal, the Twitter deal this is. And then, of course, that, as I sort of said, the general distraction for Musk, especially over his handling, his running of his other companies. I think it's true. Tesla doesn't have a chief operating officer, a COO. So Musk takes quite a hands-on view, hands-on approach, certainly to Tesla, and then obviously all of his other pursuits, SpaceX, Twitter, potentially. So distractions are what I think many analysts are calling certainly the Twitter takeover potential, and then obviously that impacting on Tesla financially, and of course with Elon Musk potential decision making. The chart, as I say, yeah, touching those lows, and sort of very bearish engulfing, actually bearish engulfing candle on the Friday. So we closed on the lows, and the whole of the range engulfed that previous bullish candle, which was a bullish engulfing candle, because that had yes, you can see engulfed and closed up on its highs. So volatile, it's always going to be volatile around key levels, and this is a key support level, as you can see. I just dropped to the weekly actually, and you can see, yeah, if we obviously lose this support, sort of mid-May, end of May support around 206, for sure. If we lose this and we've closed lower on the week, then we're potentially going back down to next support around 180 or so here. That's the 200-week moving average, yeah, 156 potentially if we lose that. Certainly, though, as I say, always volatile around key levels, potential to be a false break, and then we bounce back and hold this support. But you can see sort of resistance then sort of above, above sort of 250. So that is Tesla this week, and something definitely worth looking out for. I said we'd just run through the technicals for the US indices, and just bear with me 1 second. So the S&P, we will start with a weekly, and you can see, just checking if we have any questions. Please, if you do have questions, do write them in. But yes, technicals on the S&P. Well, we can see we're trading now. It's quite good, quite evident actually. Sorry, just lost my words. On the weekly, we can see, we're trading between these two long-term fib levels. So we've highlighted this before, as many of you will remember. This is from, the fib level is from the pandemic low up to the all-time high early this year, start of this year. And you can see the halfway point, 3505. We obviously dipped below that to 3491 actually last week, but then bounced off that level, massive bounce. We'll go into that obviously with this US CPI data and that turnaround on Thursday, Friday. Big bounce there, and then we're now tracking obviously bang on the 200-week moving average, 3599, and then we've got obviously that mid-June low at 3636. But with as I mentioned, then the next fib level, so we're trading between these two fib levels of 38.2 is at 38.15, and you can see actually the high from previous week, not last week, the previous week was actually 38.06. So some interesting candles here really, because long wicks if you like, but then we close sort of lower down, but still oscillating, still trading around these key sort of support resistance levels. And you can see them there trading around here, and then not quite, or just about holding up. There's support here. There's a channel there. You can see a bearish channel, I would say. But if we do push above this 21-day moving average, you can see it sort of held prices quite nicely there. That's at 3704. If we do push above that, then certainly we could have a look again at 3800 or so. But that is again probably the next decent level of resistance. Otherwise, certainly if we're moving lower, then certainly 3505, 3500, and then that 200-week moving average is key support. For the Nasdaq, the weekly, just look at that. We're trading below the 200-week moving average. That's at 11,221. If I just drop to the daily, you can see there we've put in that bearish channel and sort of series of, again, lower lows, lower highs, get to the top of the channel and come off. We're sort of midway through there. Again, the 21-day moving average is acting as nice resistance, really. 11,305, that is there now. Probably can extend that trend line resistance as well, which would be just above that 11,305 level for the 21-day moving average. Again, if we lose that 10,500 or so, not looking so good. Just on the Dow, where are you, Dow? There we are. The weekly also below that 200-week moving average at 29,653. We bounced from the September low at 28,715, and we're again in key levels here that you can see. Yeah, that mid-June low at 29,653. That's on the Dow. The channel, let's extend that because we've kind of broken out of it. You can see there again the top and the sell-off again near the top sell-off. We're just sort of touching out of it now, so it'll be really interesting to see whether we can bounce from here up to say 31,000 or so potentially, if we do get a breakout of this near-term bearish channel. A lot will depend on these earnings, as I said, especially in light of there not being so much US data. Okay, just looking at the US CPI data. In fact, just before I go to there, just probably touch on, don't want to be so bearish on the technicals. Certainly, we can bounce. I think I had a graphic last week and the week before about September performance. Not really. We've seen bounces before, and then here we have just seasonality. So as we head into the end of the year, the Santa rally, if you like, or just generally the rallies that we kind of get from sort of October up into December. We're entering the most bullish part of the year on a seasonal basis. Again, just sort of trying to open your mind up to different ways of looking at the market. Historically, that's what's happened in the S&P in US stocks. But of course, there are a lot of headwinds, as we said, and some of the technicals, if we break decisively key levels of support, then they do look potentially not too pretty. Okay, we'll just go into now US CPI, actually, just quickly. Obviously a long drawn out countdown, if you like, to this number. So important now, the most important economic data on the calendar now, really. And well, it didn't disappoint, did it? A few hours really of extreme volatility. I think I said in the daily, another one for the ages, really. I think the S&P, that was it the 5th biggest intraday reversal from the low, I think, ever. And just the market reversal just on that day, and then obviously we had Friday, but was massive and really eye-opening, and sort of pulled back, as I said, on Friday. But it's really around the CPI data, so the hopeful signals of inflation topping out again. They didn't materialize, so headline inflation that hardly eased, 0.4% month on month, 8.2% year on year. That's from 8.3%, so still above that 8 handle. And then US core inflation, that was 6.6% year on year, and jumped to the highest level since 1982, 40-year high, and the monthly pace was at 0.6%, so uncomfortably elevated, and surpassed actually now the level seen at which the Fed began hiking interest rates in March. Certainly a worrying signal, confirms that financial conditions are not tight enough still to significantly lower inflationary pressures, and really a clear signal that the Fed has more to do. Some of the details really, we saw, an increase in energy, jump of nearly 20% year over year. So gasoline has been falling in recent months, but then natural gas and electricity, they've been increasing. And then we've got food increasing over 11%. And then other areas, shelter, vehicles, all jumping, I think over 6%. So really these broad-based price pressures are still very evident. As I said, market reaction. Well, just before we actually look at the market reaction and just talk about that, you can see on this chart by the actual Bank of America, again, don't want to get too complex, but you can see they've told us that the core average has been 0.5% month on month over the last 3 months. So if we take that and extrapolate that, if you like, so extend that into the future, then they see core US CPI around 5 to 6%, sort of late spring next year. And then these different lines just show core moving 0.6% and continuing. So we'd be at nearly 7% still on an annual basis. If then month on month we increase by 0.4, then we're still at 5%. And then even if we increase by just 2.2% month on month going into sort of May 23, we're still at 3.1%. And obviously the thick red line there is the Fed's target of 2%. Only if we increase, and this is really illuminating, really, only if we flatline month on month for core CPI do we then get below the Fed target by May 2023. They say we would be down to 1.3% on the annual. So yes, just really sort of fascinating chart. Really don't want to get too technical, but if you just think around this core inflation number that everyone's talking about, strips out the volatile parts of inflation, but we still have these broad-based price pressures, even if we're seeing some easing pressure in goods inflation. Okay, obviously, the market reaction was incredible, as I've said. S&P opened down to 2.5%, and then really technical factors. I mean, there were so many factors people were trying to come up with of the reversal then, because we touched that 50% retracement level that we've been highlighting, and really we bounced sharply off there. That was the post-corona rally, if you like, triggered a squeeze. And it was a kind of squeeze on so much bearishness, so much recent bearish positioning, if you like. And then the indices having dropped 2.5%, the S&P closed up 2.6%, I think it was, the Dow 2.8% higher. And then those all-important bond yields, they stayed pretty high. They stayed at 4.5%. Let me just show you, actually. So this is the 10-year yield again. We can't trade this really, but it's worth looking at it just to highlight where we've come from. Sorry, the 10-year yield. You can see, we've highlighted before around this 4% level. We got up to there. You can see we moved above there on Thursday. You can see 4.08 on the 10-year US Treasury yield. That is, everybody focuses on this yield because it's really the barometer for global borrowing, if you like, US borrowing. Yeah, that's pushing up to the highs, but then obviously came off it. But then even the 2-year yield, which is here, pushed above 4.5%. So the 2-year yield is the interest rate on the US government Treasury yield, and this tracks the Fed funds rate, so the interest rate that the Fed sets. This tracks it more closely. So you can see, yeah, we pushed up towards those levels, those key levels, 4% on the 10-year, 4.5% on the 2-year. And then we saw this strong reversal in the stock index until Friday, of course, and we've highlighted then that pullback and then some of those technicals. Just on those reasons, actually, for the turnaround, always interesting, really, when analysts are sort of, and myself included, really, ourselves, really, that we're trying to figure out reasons, and sometimes there's not one specific reason. There's the short squeeze potentially. There's hedging. There was the US peace dialogue story. And there's also actually an ECB story saying that the peak rate might be lower, around 2.25% actually against that market's 3% that we've highlighted before. And then obviously there's speculation around the UK government at the time, the U-turns. So sort of all potentially helping risk assets and this bid. But obviously then since we, on Friday, we reversed some of that. And now I'm just looking at futures again, we're bouncing again. After that 2.3% sell-off on Friday in the S&P, for example, now future showing we're going to open at 1.2% up. So a lot of volatility and a lot of volatility around the technicals and those key levels. And like we say, once we hit key levels, it's not all straight line trading. We might go through it, but then there's certainly buyers step in to defend those levels, and you can expect a lot of volatility around those. Just briefly, last week we also had the FOMC minutes, again hawkish, basically officials indicating they feared doing too little to get ahead of inflation, more than doing too much. So again, it's unlikely for them to pivot. You would think. And then the Fed minutes, really, nothing else majorly of news. I think they significantly revised down estimates of US potential output because of lower productivity and weak labor force participation. So that means that the US economy really is seen as operating above capacity until 2025 potentially. And then again, what does that mean? Well, the Fed's battle against inflation, potentially it becomes even bigger. We also had, apart from the minutes, we had US retail sales. They were flat versus August. Nothing too market moving there, but we did have actually stronger than expected inflation expectations in the University of Michigan consumer survey. So that grabbed some headlines and really sort of kept those yields, those bond yields up near their highs. This week on the calendar, US calendar, it's relatively light. Most releases kind of as secondary importance. We do get housing starts data. That's now starting to get more focus. Due to obviously mortgage rates soaring now above 6%, I think, for a 30-year mortgage in the US, not seen for many years. And so there is more focus on housing data, really to assess what is going to happen to housing markets potentially. And if there's a downturn there, which we're kind of seeing already, then potentially that affects the consumer again, another hit to consumer activity and growth. Remember again, we've highlighted this before, but shelter, those costs, they're a third of the US inflation basket. So a potential housing downturn really has also the effect actually of driving inflation down faster next year. So sort of competing, conflicting forces there to think about. We get initial jobless claims data, that weekly data always on Thursday. That will inform us, of course, about the labour market. And those are sort of the main releases. Secondary, as I say, potentially, depending on the housing data, really, what we get this week. I said I'd look at gold. Certainly that you can see on Thursday. Let's just blow it up here. This is this candle here on Thursday. So we sort of tumbled, didn't we, after the US inflation print, but then recovered back into the sort of 1660, 1680 range. See most of last week. As I said, those inflation expectations on the Friday in the University of Michigan's report, they sort of raised again, as I said, expectations for more aggressive rate hikes. And then sentiment has obviously improved in the dollar. That then pushed gold lower. And we've highlighted this sort of area, this zone of support resistance. The 2021 spike low at 1677. That's reinforced by the pandemic bottom at 1676, and then the July low around 1680. So yeah, we weren't able to push above that on this reversal of US CPI when the dollar fell. Risky assets rose, and then sort of we've kept below that level, which remains key then. Key resistance along with that, well, you've got the 21-day moving average at 1670. Potentially, if then we break down through last week's low at 1640, then we get to have a look again at sort of 1615, 1614, 1615, which is a fib level from, where is it? From let me look, sorry, the 2018 sort of lows, and then the high from August 2020. So yeah, we've got that fib level at 1617 potentially. Okay, just briefly, sorry, we're taking quite a bit of time here, but we obviously have sterling and everything that's going on there, amazing volatility, of course. If we step back, markets have been questioning all those vast tax cutting measures in the light of course, spiraling inflation pressures above 10% in the UK, and they all made worse by potentially those plans, and especially in the absence, of course, of an independent assessment. That's all now been taken back. An amazing sort of turnaround in the UK. Just this morning, we've had the new finance minister, the new chancellor, Jeremy Hunt, announce that he'll be reversing almost all of the tax measures set out in that growth plan, in that mini budget from the 23rd of September. It's kind of back to being a mini budget now from sort of this growth plan, which it was heralded as. So many measures in there have now been reversed. So as I say, back to a kind of mini budget, if you like. The two big surprises from this morning, really, the government's now scrapping the planned income tax cuts indefinitely. So we won't even get a cut even in 2024, as the previous Chancellor Sunak had planned. And then secondly, there's a shortening of energy bills, the energy bill support scheme. That was meant to be for 2 years. It's now only going to last until next April. So again, a reversal of what PM Truss had said only last week, and was kind of telling the opposition party, at least, that she was very proud that they were extending that scheme or pushing that scheme out for 2 years. So a dramatic overhaul in those plans, which obviously sparked massive market turmoil. I think the measures raise around 32 billion, but sort of this black hole in finances, in the UK finances, sort of 60 billion and above, I believe. So it all sort of adds to this further undermining of UK, the PM Truss is position. That's a kind of major initial takeaway on the sort of political side, if you like. Trustonomics are buried and the mini budget is in tatters, just some of the headlines, I believe. And sort of political commentators at least saying, well, it's not a coup, if you like, but the CEO is in charge now, not the chairman. So that's sort of Jeremy Hunt being the Chancellor, being in charge, and PM Truss really are kind of just looking on, if you like. Amazing turn of events. I think the phrase as well being bandied around is that the Prime Minister is in charge, but not in power. So in office, sorry, I was just trying to remember the phrase. The PM is in office, but not in power. But for markets, well, you can see this chart here actually is the 10-year gilt. So that's the UK government bond yield. And you can see, if we just drop down to the hourly, well, you can see just today, Friday, where PM Truss came out with her 8-minute press conference, didn't really convince markets at all. But then obviously since today, we've had these yields falling, which is certainly good news for markets, believing that there is more stability, more credibility potentially with some of the plans of the new finance minister. You can see then we're falling below 4%, which had been sort of a key marker in this 10-year interest rate. And we're sort of falling below there. So really interesting sort of potential sort of positivity from the market. Before we look at cable, actually, I should say we do get data, UK data this week from which is UK CPI, sorry, and then also UK retail sales. Kind of slightly might be of lesser significance, or would have been of lesser significance, because everything was focused around certainly the impact of the fiscal events on the UK economic outlook. That's still the case. We're still uncertain, but certainly, I've just highlighted there with the interest, the bond market reacting relatively positively then to this morning's announcements, which means we might get then some focus back to data actually now after that sort of stability announcement, if you like, from the new Chancellor. But certainly politics, speculation around PM Truss will or is growing massively now, potentially for her to step down. I think the issues are around the successor and obviously being seen to have another leadership contest. It is really not a good look politically, but you never know, certainly in politics. And I've kind of been trying to stress this actually on some of our daily commentary, just around the fact that when politics kind of entwines with financial markets, you do get certainly, I believe, massive volatility. And that's, of course, what we've seen. Obviously, lots of other factors, but of course, what we've seen in UK asset markets, UK bond markets, and sterling. Just on the UK CPI, I think expectations are for the year-on-year figure to climb above 10% from 9.9%. Expectations, I think, for 10.1%. On the headline year-on-year, the core year-on-year, that's set to rise to 6.4% from 6.3%. And again, it's kind of the same trend, potentially, economists, I think, are saying should be seen in this data as compared to similar to the last data. So potentially we see declines in contributions from fuel costs, and they're offsetting upside pressure from food. And I think petrol prices, they've fallen by over 4% on average in September. And the secondhand car market, that's continuing to soften. But then we have these offsetting other price pressures, as I say. There will also certainly be evidence of continued inflationary momentum, especially given the weakness of sterling over September. And that, if you think about it, that pushes up imported costs, particularly food, and that tends to react quickly to changes in the exchange rate. So looking further ahead, concerning the Bank of England, The September statement that noted that given the energy price guarantee, the peak in measured CPI inflation is now likely to be lower than projected in the August report. So just under 11%, I think, in October is CPI projected going forward. But nevertheless, energy bills will still go up. Certainly they're going up if you live in the UK. And certainly combined also with the indirect effects of higher energy costs generally, then inflation is expected to remain above 10% over the following few months, then before starting to fall back. So just something to note about UK CPI still being sticky, still being elevated. Yes. Just on market expectations then, I'm just trying to, I was just checking actually where we are with market expectations, the Bank of England. I think there's obviously hikes have come back. There were around at its peak when we had all this market turmoil, then we had sort of a peak Bank of England rate near 6%. But now that's come back down to around, I think, 5.3% by May. We had over, I think, 280 basis points of tightening by year end. Amazing amount. That was a peak sort of market turmoil, if you like, and now that's back to around 175 basis points of rate hikes by year end. So chance of a 75 basis point hike at its next Bank of England meeting, they're around 60%, I think. The chance of a 100 basis point move, they've come back now sort of below 30%, I think, nearer 20% now, having been closer to 40%. So sort of rate hikes are coming back, if you like, but they're still evident, and we're still sort of having the Bank of England potentially hiking as growth certainly slows. For sterling, finally, we finally get there. Sorry, this is quite a long webinar, much longer than normal, but so much to cover. You can see sterling. Let's look at the 1 hour chart. You can see sort of, sort of climbing into the Chancellor's statement. We sort of kept near, at least near the highs for the day. The highs for the day above 113, and we're just tracking above 113 now. Really interesting as the US sort of come in, traders come into their desks across in the States. It's always interesting to see the reaction potentially there, where we sort of dropped lower, as I say, or slightly lower after after Jeremy Hunt's statement, but now we're sort of seeing some support in sterling. Longer term, I mean, I've got fib levels here, short term, very short term fib levels, and you've got support at 112.26, but we're coming up against this sort of shorter term trend line resistance, if you like. And then 114.09 is the pandemic low. So that is acting as resistance to a move. Potentially, though, you can see we've had an inside day there. So that red candle, an inside day means the whole of the range is inside the previous day's candle. And potentially then, if we do push higher, then that's a sort of bullish flag, if you like. But really, we've got 114.09 to battle with for sure, to push above there. Then you've got the 50-day moving average, 114.96, potentially. Otherwise, support on the downside, 111.44, that's the 21-day moving average. If we lose that, then we're going, you would think, below 110. I didn't show you the chart, sorry, US CPI, but we've talked about that. And you can just see core headline and core as well, core potentially pushing up. Okay, covered so much there, an hour long, I think. So hope you've enjoyed it. Hope you've taken something from it. Still got a lot of volatility, earnings to look forward to. Kind of less data, but still a lot going on. Please follow us on social media and obviously on our website with our daily commentary. And we look forward to speaking to you next time. We don't actually have a webinar next Monday, but the following Monday for sure. we'll have a webinar then. Okay, take care and all the best.